So imagine you're spending your whole life at the track, sweating over the odds, trying to guess the absolute fastest horse.
Trying to pick the one guaranteed winner.
Exactly. Or, you could just buy the entire racetrack. And that is basically the fundamental premise of the source we're looking at today, the S&P 500. The simple path to lasting wealth. Welcome to today's deep dive, where our mission is to break down this exact concept.
Yeah, it's a great topic. The cultural narrative is always that building wealth requires intense trading screens, perfect timing, and somehow predicting the future. But the historical data, we're examining points in the exact opposite direction.
Okay, let's unpack that data because we all know what the S&P 500 is, right? It's the benchmark. But if you buy into an index of 500 companies all at once, aren't you essentially diluting your own massive wins?
Well, it might feel like a drop in the bucket if, say, one of those companies has a massive breakout year, but you have to look at the mechanism of what you're actually holding. You aren't hunting for a lottery ticket here.
Right, you're not trying to find the next Apple or NVIDIA before everyone else.
Exactly. What's fascinating here is that an index fund is naturally self-cleansing. When a company stagnates or fails, it just naturally falls out of the index, and a rising star takes its place.
Oh, so you're essentially betting on the macro growth of the entire U.S. economy?
That's exactly it. Because of that self-cleansing mechanism, you're capturing aggregate growth. That's why it continually hits new highs over time, averaging historically around a 10% return per year over the last century.
10% is solid, for sure. But the real power here is how that 10% behaves over time through compounding. Here's where it gets really interesting. Instead of that old snowball down a hill analogy, think of it more like owning a factory.
I like that analogy.
Right, so at the end of the year, instead of taking your profits and going on vacation, you use that cash to buy another machine.
Yeah.
Then the next year, that new machine generates its own profits, which buys even more machines.
And that is exactly how dividend reinvestment works in these funds. The math and the source really highlights the power of those factory machines.
Break the numbers down for us.
Sure. So if you consistently invest just $500 a month, after 10 years, you've built about $100,000.
Wow. Okay, and what about 20 years?
In 20 years, it's over $350,000. And at 30 years, that exact same $500 habit crosses $1 million.
Wait, really? $1 million just from $500 a month?
Yep. That mathematical certainty is why Warren Buffett notoriously advises that a low-cost index fund is the most sensible choice for the vast majority of people. The ultimate secret ingredient isn't having massive wealth to begin with.
It's simply time.
Exactly, just time.
And getting that first machine running just takes a couple of taps on an app today, like Robinhood or Fidelity. You only need a few dollars to start. But let me stop you there, because we need a reality check. The market doesn't just go up 10% like clockwork every year. If the market crashes, say, a 50% drop like we saw in the 2008 financial crisis.
Or the COVID-19 crash, yeah.
Right. Mathematically, it takes a 100% gain just to get back to zero. Doesn't that completely destroy the timeline? If the math is foolproof, why doesn't everyone do this?
Well, mathematically, yes, major drawdowns are brutal. But if we connect this to the bigger picture, the reason most people fail isn't the math of the recovery, it's behavioral economics.
Human panic.
Pretty much.
Yeah.
It's a psychological principle called loss aversion. The human brain feels the pain of losing $1,000 roughly twice as intensely as the joy of making $1,000.
Oh, wow. So when the market drops 50%, panic just totally overrides logic.
Exactly. People sell at the absolute bottom just to stop the psychological pain. But the data shows that investors who hold steady and even keep buying those factory machines at a steep discount during a crash.
They benefit the most in the long run.
Right, because historically, every single crash is eventually followed by new highs.
So to summarize the core rule here, you buy consistently, you hold long term, you ignore the noise, and you let time do the heavy lifting. The goal isn't to outsmart the market, it's to outlast your own psychological impulses.
It really is. It changes everything about how you manage your money.
It definitely leaves you with a completely different mindset. So think about this for a second. If history proves that every major market crash has eventually led to new highs, how does that completely change how you should react the next time the news tells you the sky is falling? You don't have to stress over finding the fastest horse anymore. You own the track. Just enjoy the run.